Good. So, good to see you guys, and welcome to our Finance Mastery workshop. And I think everyone's been to a Mastery workshop before. I think, but for those watching that haven't, there we go. That's our series of workshops, and obviously this one really is around the numbers side of things. So that's at a basic level of really understanding, what the numbers of a business are all about and what some of the key areas that we need to be looking at. So in our series of 6 there, and they repeat every 3 months, as you know. So as we always start off, we will really just sort of, as we've got sort of small group today, we can make it a little bit more interactive, which is good. So if I go through each of you, is there something specific you want to make sure that you get out of the workshop today? So Damien, what about you?
Put me on the spot here. I probably need to work out how to work out what my profitability is, rather than just looking at the number at the end of the month or even at the end of the year. I know how much I want to, or I know at the end of each month if I've made a profit, not necessarily whether each job's made a profit.
Yeah. So
I've got a general feel.
Yeah.
But I'd say it's a bit finger in the air rather than knowing exactly.
Okay, so getting into a bit more granularity into where the profit comes from.
Yeah.
So good. Ranjit?
Yeah, so basically taking on this new member of staff, keen to look at quick ways of 5-minute back of the fag packet kind of stuff where I can just keep an eye on how he's doing in terms of financial contribution to the business. So those kind of key red lines just on him, as an individual.
Cool. Good. Brian?
Balance sheet.
Balance sheet. Good. Everyone ignores the balance sheet. So we'll we've got some good stuff on balance sheets to go through. Good. Cool. So what we're going to start thinking of is within our sort of finances, everything we do, we start with this little formula. Who do we need to be? What do we need to do? What do I want to have? Okay, so with sales and marketing, it's generally quite easy, because I want more leads, I want more higher conversion rate, I want more sales. When it comes down to finance, and clarity around what we want to have can be a little bit more difficult. Okay, so I'm not going to start with have. I normally start with the have this time. I'm going to start really with the B side of things, and then we'll move into the have as we go through. So our B is often about our beliefs around numbers. Okay, now for me, I was brought up with a father who was a chartered accountant, who was in practice, who then started his own business. So I then studied A-level maths, went to university, became an accountant. So for me, numbers, I was just brought up with them. It was like sort of, the first thing I learned about business was a P&L account and a balance sheet. So my beliefs around numbers have always been, you've got to have them, you've got to understand them. I've never been scared of them. I've actually sort of, sometimes use them perhaps more than I need to. I'm a bit more sometimes too reliant on the numbers rather than going with gut feel that some people do. So, but we've all got slightly different beliefs on it. Our mindset around numbers is different. So one of the key things is to really understand for you is where are you starting from? When we talk about money, and we talk about the numbers in the business, where are you coming from with this? So yeah, have a think about the sort of positive and negative issues you have. You know, when I sort of say money to you, David, what sort of things, what sort of words to describe money come out for you?
What money, as in turnover?
Yeah, just sort of, you know, if I said, give me some emotional words around money.
I like it.
You like it? Cool. It's a good place to start.
The kind of, well, yeah, it's not something I generally have to worry about too much.
Yep.
Yeah, I'm quite fortunate in that sense, but it's just, well, I suppose it's just something that's there. It's something that it's a vehicle that enables me to do stuff.
Okay. Yeah. So there's not a massive emotional connection to money on that basis. It's just something that I use to do what I want to do with.
I'm more connected to the end result rather than the actual cash.
Yeah. Cool. Because yeah, money at the end of the day is an enabler. It enables you to do stuff. You know, if you've got lots of it, you can do lots of stuff, and if you don't have much of it, you can't do much stuff.
Yeah.
So we've got to be thinking. You know, if we do have some negative thoughts around, so give me some negative thoughts around money, Brian. What would a potential negative thought be?
Well, it's a common phrase, isn't it? Money's the root of all evil.
Yep, money's the root of evil. Yeah, money corrupts. Yeah, filthy rich. You know, so if we've got negative mindset around money, then it's very difficult, you know, for you to gain more of it because your subconscious will actually repel it. Okay, you might sort of consciously be thinking, I want more, but if you've got negative thoughts around it, then it might well drive you away from it. So you've got to sort of first off with this is actually really think about, what do you hold to be true about money? What are your beliefs about it? You know, do you want more of it? As Damien said, do you see it as an enabler, so it allows me to do good things? You know, I know, Ranjit, for you, you know, there's a lot in your religion about making money and then giving back to the church and giving back to, you know, friends, family. So you're not doing it for yourself, you're doing it for other people. So, you know, what we want to be able to do is whatever it takes is to put a positive belief system around, you know, the money that we can make within a business. Because if we don't have that, then anything we do is going to actually hold us back. Okay, so really start thinking about, you know, if we do have some negative beliefs, one of the first things we need to do is change that. And to be honest, one of the best ways to change it is to hang around other people, you know, positive-minded people around money, because they will actually influence you as well. The other way is to read more. Okay, read more books about wealth creation and what you can do with wealth. You know, really be thinking about, you know, if I want more money, then I've got to have a mindset that is going to attract more money to me. Because if I've got a closed mindset, if I think money's a negative thing, then again we'll start putting blockers in the way to actually achieve it. No matter what strategy you come up with, subconsciously you'll start to repel it. Have you got any sort of, you know, can you think about family, friends that have got a more negative view of money than you have? Ranjit, you must be quite a few in your sort of
What, a negative view of money?
Yeah.
No, they've all got plenty of money. They say, ask and ye shall receive. And that's the thing.
So very much from a cultural point of view, you know, and I think that's why a lot of Sikhs have, you know, gone on to, you know, bigger and better things, because that's the mindset around it. So, whereas you look at some religions, actually hold you back. You know, that your money is the root of evil and things like that come from certain religions, which means that it's difficult to actually then have that positive mindset around it. Family, friends, we've all got people that have been corrupted by money, and we think that money is the cause of that, and it's not the money that's caused it. It's other social things that have gone in that person's life. So it's very difficult for some people to break that that barrier, but that's what we've got to do. So we've got to ask ourselves that question first. So once we've gone across the fact that we do want more money, that money is a positive thing, it's going to help us move forwards, achieve all the things that we want to do, and we were in that mindset, then we've got to come back to the numbers within our business, because the numbers in our business are just a scorecard. Just as any other game that we play, is we've got to keep a score. So the numbers within our business, the sales, the expenses, the profit, the loss, the balance sheet, these are just our ways of actually keeping score. So we've got this sort of fact that are the numbers a left or right brain thing. So left brain being our logic, analytical side of things, the right brain being our emotional side. So what would you say, Brian? Are numbers sort of for you more logical, more emotional?
For me personally, it's definitely emotional, I would say. I find them more confusing than anything else.
Right. Yep.
Yeah.
So for some people, they're more emotional. I get, every time I see them, I feel something. I feel down, I feel up. If I've got money, if the numbers are positive, then I feel good. If the numbers are negative, then I feel bad. And the challenge we have with that is, if we feel that way and we get bad numbers, what do we tend to do with looking at the numbers in the future?
And then shy away from looking at them in the future.
Shy away, yeah. Well, we've got Chris. Chris,
I'm here.
Didn't see you sneak in. It's normally Ranjit that sneaks in that I don't see. So yeah, I
didn't register, so I had to get Ranjit to send me the link.
God, you destroy my system, so I don't know that you're not expecting you. So yeah, so we shy away from them. We ignore them. Okay, and this is what I see. When people get into too much debt, is they look at the debt that they've got and they go, oh, that makes me feel really bad. I feel depressed that I'm in so much debt, and therefore they start ignoring it, and the debt just builds up because they put it to the back of their mind. Okay, so some of us are going to be a little bit more emotional when it comes to numbers. Who would see numbers as more of a logical left brain thing? They're just, Damon, you sort of mentioned it there. Numbers are just numbers. If they're up, they're up. If they're down, they're down. I
quite like playing with numbers.
Yeah. So and I think that's a good point. The more you play with them, the more you use them, the more you disincentivize yourself from them. Okay, because it's this. If we go onto an emotional roller coaster with numbers, then that can actually hold us back.
Especially when they're just on a spreadsheet. The cash in your pocket probably feels a bit different to me to actually numbers on a spreadsheet.
Yeah, it does. I feel, I've had times where I've had, a few £1,000 sort of in cash in my pocket, and that makes me feel very uncomfortable. But it's mainly because it's a security thing. I think I'm going to get mugged. But actually, the numbers on the on the P&L, the balance sheet, we've got to remove that emotion from them. Okay, if we feel emotional about them, then it's going to sort of hold us back, because we end up in this loop, this think, feel, act loop. So if I think about the numbers as being negative, and I feel bad, then I'm going to behave in a certain way that will actually, reinforce that thought again. Same way with a positive way. If we have a positive thought about numbers, then I have a positive feeling, and therefore my behavior is, oh, actually, I like playing with numbers, as Damon said. Yeah, I like putting them in a spreadsheet and seeing what happens, and that drives another positive thought, which drives a positive feeling, that drives a positive behavior. So we've got to really understand how we're thinking with this, okay, so that we can actually deal with it. Because if we don't, then it causes us problems. We start ignoring the numbers, we run away from them, and we're not using them to actually our own benefits here. Okay, so if at any time you catch yourself with a negative thought, I need you from now on to actually stop, almost catch it before it creates a feeling. If you start to feel bad, it's fine. Why am I feeling bad about this? These are just, certainly the numbers in our business are a reflection of what's happened today. They're not a reflection of what could happen in the future. If we do nothing differently, then they'll be the same. But if we actually look at it and say, right, just because I made a loss last month does not mean I'm going to make a loss this month, as long as I'm doing something differently. Okay, I just this week we're looking at a company that potentially we were going to buy with a client, and I looked at their reserves and profit and loss, and they've been going since 2006, so they've been going 14 years, and they'd lost to date 12 million quid. So in 14 years, they'd lost 12 million pounds. Now, you can imagine sort of, the shareholders and the people running that business must have a bit of a negative feeling about that. Nobody actually likes losing that amount of money, but they're clearly on they must have a strategy around it, because there's no way a business could run for that length of time with that amount of losses without some form of strategic plan behind it. Okay, so we've got to understand that emotion is going to be running all the time. We've just got to deal with it. If we're too unemotional about it, then I think it stops us making better decisions. If we have made a loss, you should feel some emotion that you want to fix it, not just carry on regardless. But most of the time, it's not because we don't want to fix it, it's because we start to ignore it. We just leave it, we're worried about it, therefore we don't look at it. And if we don't see it, then it doesn't really exist, until it actually becomes a mega problem some way down the line. So we've got to look at these negative beliefs and remove them. Okay. So what I want you just to, before we move on, just write down, 5 potential negative beliefs that you have around money. Yeah. And then look at a way to actually overcome those going forwards. Okay. So just because if you're aware of them, then you can do something about them. Okay, so some of that could be, what we call affirmations, so positive affirmations, which are I am statements, which reinforce the positive around it. It could be a reading exercise. If we don't understand them and I feel bad about it, then we need to get you on some more education around it. Okay, some more learning. If it's spreadsheets you're not good at, then great. We need to put you on a spreadsheet course to actually understand spreadsheets more. So. Because a lot of these beliefs are going to be just fears. Yeah. And fear stands for false expectation appearing real. So if we think we don't have enough money, then we start to project forwards what that could actually mean. And that's where we start to, it means I'm going to lose my house, I'm going to lose my home, I'm going to lose my family. If these negative things happen, and that can actually cause us to then stop doing what we're actually doing. If we make it more logical, then it just becomes a numbers game, and then there's no emotion attached, therefore there's no fear attached, therefore we can sort of move forwards more with what we've got to do. Okay, so if you've all got your 5, don't have to share them, just make a note of them. Perhaps we can talk about them in the groups, the coaching sessions later on, and If you've got one that's particularly holding you back, then we need to work out how do we deal with that particular one. So I mean, you've done quite a bit of work on this, haven't you? So is there one that you want to share that you've worked on and overcome, or getting better at, I should say, because
yeah,
always a challenge.
Well, one of them is a bit of a strange one, Kevin. Every time I go to look at my figures, I hear your voice. So that's really off-putting.
That should be encouraging, Chris, not off-putting.
No. So yes, we've done a lot of work on this, and one of the things I've just is a sense of realization probably over the last year or 2 years, and one for me that I've been working on, or I still struggle with, is that I have a feeling of loss when I pay out money, when I pay for things, whether it's for bills, invoices, staff wages. I have a real feeling of loss, wanting to hold on to money as long as possible. And that's caused me quite a lot of issues in different areas by having that mindset.
And yeah, that fear of loss, it can be a big one. It's and I've seen lots of businesses that have suffered because of the fact that they hang on to their money, and they'll build a big bank account up and they won't spend it, and they don't reinvest back in the business, and they don't pull it out and go and buy nice things. It just sort of sits there. And the one thing you've got to understand is money needs to flow. Money's like a river. Okay, it needs to flow in and out of the business. Okay, now when it comes out, you want to divert some of it into your own personal, shareholder wealth. But there's no point, if you dam a river, and you build a big pool of water, well, that's okay, but eventually it starts to flood and go stagnant. So we need that money to flow through the business. Okay, so it comes in, it goes out, comes in and goes. It's not a problem to come in and go out, as long as we know where it's going and we're in control of it, and it's not just flooding planes and disappearing, and we don't know where it is. As long as we're controlling it, then the flow of business in and out is a good thing. Okay, the more that we use money's money's enabler. It should enable more things to happen. So if we are very profitable with our business and we're making lots of money, then great. We should have a plan for that extra money. Where are we going to put it? Are we going to invest it into another property? Are we going to put it into our pension? Are we going to buy more assets? Are we going to buy more people? Okay, making money for money's sake isn't the game here. We've got to have a plan and a strategy of what we're going to do. So the first thing that, for coming back to numbers, profit and loss accounts, balance sheets, key performance indicators, and we've got a fear around those, oh God, I don't really understand them, then the first way that we've got to overcome that is to actually say to ourselves, what gets measured gets improved. Okay, we cannot improve anything in our business unless we can measure it. So if I take this back to a sport, a sporting analogy, and for me the easiest one for that is golf. Okay, the high level score on golf is the number of shots you take to go round a golf course. But if golf is an amalgam of many different sports within golf, there's the putting game, there's the chipping game, there's the pitching game, there's the long iron game, short iron game, there's the driving, there's the saves, there's the sand game. So there's all these different games that make up the game of golf, which is why for me it's so addictive, because you're trying to improve so many different areas. So while on the surface, my score for the whole round is the ultimate aim, which is like making profit in our company. When I break it down into its individuals, I've got to understand, it's my drives that hit the fairway, my greens in regulation, the number of putts I make, the number of sand saves I do, the number of up and downs I do. These are all detailed numbers that I would start to record if I wanted them to improve. Because I can't just go and say, I want to improve my golf. Well, what part of it? Do I want to improve my driving? Do I want to improve my chipping? Do I want to improve my putting? So I need to understand how I'm scoring each individual area so that I can then go back and improve that. So we've got to start to understand that, you know, our profit and loss and our balance sheet are, well, profit and loss, the profit that we make is like the score at the end of a golf round. Yes, it's important, but there's more detailed, more areas that I need to focus on in order to improve that ultimate score. Okay, the valuation of my business, you know, is a multiple of the profits I make, my EBITDA figure, earnings before interest, tax, and depreciation. But that multiple is made up of a number of factors. You know, my customer base, my supplier base, my employees, my systems, my processes, all of those added together make that multiple. So we've got to start understanding that business is a far more complex thing than just the amount of profit that I make at the end of the period. And as I think, you know, Damien, you were saying that, you know, I look at the end result, and if I've got cash in the bank, then I'm happy. Yeah, that's great, but that's like saying, you know, if I score less than 100, I'm happy when I play golf. Well, great. If that's all you want to do, then that's okay. But if we want to get better, if I want to actually improve my golf, then I've got to break it down into its component parts. And the other thing to always remember is the numbers are just a reflection of the past. You know, that's all they can be. Yeah. So just because I scored badly, you know, when I played golf the other day, doesn't mean I'm going to score badly the next time. As long as I take action, I do something differently. I've got a plan, I've got a strategy, and I practice. You know, if I can practice between rounds, yeah, then I should get better. Same thing with our numbers in our business. If I have a strategy, if I have a 90-day plan, if I'm working on all my different areas in the business, then I can actually improve the overall number. It might not happen overnight, but I'm working on it to actually make it better. So it's really key to think about that. I see so many people that go, you know, oh, I've had a bad month. You know, the numbers have been, you know, the numbers have shown that it's, you know, made a loss or the profit's not as good as it should be. And then they get all depressed and worry about things rather than actually saying, okay, well, the numbers showed that the actions I took last month led to this. Yeah, but that doesn't matter because what I'm going to do this month is actually going to be so much better. Okay, so, you know, if we do nothing, if we have no plan, no strategy, and yeah, you are going to get down about the numbers. But if we know that we've had a bad month, but what we're doing is to make it better next month, then we can have that confidence to actually drive forwards. So the numbers really are important because they are the score sheet. You know, they can provide a barometer of what's happening. You know, so I'm not saying don't ignore them, you know, because they're the history. You know, they give you a reflection of what's happened. Yeah, and so what we're looking for is more improvements than actually outright figures. They should motivate us. You know, if your numbers are not motivating you, then, you know, you're really looking at them in the wrong way. Now, if I go out and play golf or any sport and I do well, yeah, how does that motivate me next time?
Are you going to be motivated to commit next time you play?
Great. Yeah. So next time I play, I did really well last time. Therefore, you know, I want to do better next. I want to do as well, if not a bit better next time. If I have a bad round, how does that motivate me?
You'd be silent like this.
So if I've had a bad round of golf,
Unless
You're not going to do it. You don't want to do it.
unless you're prepared to learn lessons from where you went wrong, it's going to be demotivating.
but I'm looking on the positive side. Why would it motivate me? Why would a bad round actually motivate me more than a good round?
Could be easier to make an improvement.
Yeah. I can't be as bad as I was last time. Next time it's going to be better.
Yeah, I've seen you play, yeah.
Well, you could.
That's a joke.
But if you have a bad round and you think, oh my God, you know, next time I'm going to play just as badly as that, and that's, you know, the best I've got, then you'd give up the sport, wouldn't you?
Isn't it Dyson said, in order to succeed, first you need to learn how to fail.
Yeah.
And yeah, most successful people have failed more times than you will ever.
Because you learn, if you have a good round of golf, how much do you actually learn from that round of golf? If you have a bad round, you look back and you think of all the bad shots you played and you try to play better. So we've got to start seeing, the numbers. Again, we're moving away the negative emotion to the numbers. Positive emotion to numbers is fine, because it will drive us to do more. But the negative ones are the ones that hold us back. So we should be able to see motivation from a negative number as well as a positive number. So, and if we're motivated no matter what the numbers say, well, great. We're always moving forwards. The other key thing to numbers is they are universally understood. So you can do a set of profit and loss account in the UK. You can go to China and do a profit and loss account. You can go to Australia. You can get anywhere in the world. Numbers are the same. Languages are differently, but numbers are all the same. So I used to work with a Dutch company, and they all spoke Dutch. They spoke pretty good English as well. But when it came to numbers, we all were on the same page. We all knew what those numbers said and what they meant. So that's a great thing for me is, it doesn't matter. I can employ people from around the world. When it comes to the numbers, they all understand it. They allow us a comparison. So we can compare one period to another period, this period to the budget, this year to last year, this month to last month, this week to last month. Okay, numbers in isolation actually don't give us a lot of information. So if I said to you, last month I made £1 million. In my business, last month I made £1 million. How do you feel about that? Good, yeah. With it, hands up who doesn't want to earn £1 million next month. So
I'd rather have 2, please.
Okay, so if I said to you last month I made £1 million, but I budgeted to make 5 million.
Yeah, that's not so good.
It's not so good, is it? Last year I made 10 million. 1 million isolation doesn't mean anything. So whenever we do numbers, we need to compare them to something. Now, the lazy way is comparing to last month, last year. The proactive way is to set targets and compare them to targets, and we'll talk more about that later. Reflection of past decisions, we've talked about that. They should enable us to make decisions. Okay, better decisions. So I used to had a client a few years ago, and they were 23 million turnover company, and I talked about key performance indicators, and that's fine. We measure everything. Okay, so I went into that, and they said we have all the reports up on the wall, and we look at these on a weekly basis. So fine, that's great. So I went into their office and saw these charts on the wall, and they're all green. Every chart was green. And I went in and went, so you're measuring everything, but all of your charts are green. So what do you talk about? What decisions do you make as a result of looking at things that are all green? Because if they're all green, what does that say?
No need for improvement.
We're okay. We're doing well.
Keep doing the same.
We're doing the same. So why would you change anything if everything was green? Now, the bizarre thing was this company was losing money. So we're losing money, but every single KPI you're measuring is green. I don't get that. What do you think was going on in that company?
Covering up.
Covering up. Yeah. I'm going to measure things that I can win at rather than things that I lose at. Because generally speaking, what's happened in the culture of that business is if I show a red number, what happens? So if I've got my department, everyone else in the company is showing green, and I
You're
come in with a red number.
ostracised.
You
Yeah.
look bad. Yeah.
I'm shit.
Yeah.
I'm doing bad. So no one wants to feel bad. No one wants to look bad. No one wants to go around a golf course and score a bad round. No one wants to play football and lose. But in the game that we're playing, we have to accept that we are going to lose. We are going to score badly. But if we don't know what we're doing badly, then what are we going to focus on and improve? So they had a culture of, when we show red numbers, we get shouted at, we get told off. So fine, I'll just show green numbers. I'll find some areas of the business that I can win at, and I'll show you those. But they have no reflection to the game that we're playing, which is trying to improve the business, and in this case, make some bloody money.
Yeah.
So we have to get, not only for ourselves, but the culture in the organization, that if we show bad numbers, that isn't a bad thing. It's a room for improvement. So we have to.
Formula One philosophy, isn't it?
Yeah.
No blame culture.
Exactly. So there's a really good book on this called the Checklist Manifesto, and the guy that wrote it was looking at the difference between the medical profession and aviation. Okay, and he went back sort of to the early, late 1800s, early 1900s, where flight was coming in, and the health service was coming in. They were sort of developing together. And he looked back there and he said the deaths per 1,000 people, were about the same at that sort of time. You were just as likely to die when you went into hospital as you were if you took a flight. So, but over the years, if you look at it, the deaths per 1,000 people that go into hospital compared to the deaths per 1,000 people who fly, which one do you think has improved the most? Flight. Okay, so it got to a point where in the sort of, I think he was doing this study in the 1990s, early 2000s, that it was, I think it was 1,000, I don't know, 1,000 times safer to fly than it was to go into hospital. And part of that is people's fear. People had got so used to people still have a fear of flying, but not a fear of hospitals. So the irrationality to fears. But the key to it was, in hospital, if a doctor does something wrong and a patient dies, what happens?
Probably cover it up.
It gets cut, but if it's found out, what happens?
Doctor struck off.
Doctor struck off. Yep, he's hounded out of the profession.
Negative.
So what do they do in order not to do that? Cover it up. In aviation, they had exactly what you said, Damien, was if there's an accident, there's a no blame culture. We are not going to blame anybody. What we're going to do is find out why it happened and make an improvement. And the interesting thing is, if you watch Sully,
Yeah.
Yeah. That was a real anti the whole aviation industry, how it's been built up, because it became a blame culture, didn't it? Or it came very close to blaming him for the issue. They were trying to find a reason why it happened. And that was, when you understand the aviation industry, it was so against what they stand for. So what we're looking for in our business is, look, if we've got bad numbers, I want you to come forward with them. I want you to actually, to look at them, to understand them. And as long as you come up with a solution of what you're going to do to be better, that's okay. But if we have a blame culture, if we start knocking people for having bad results, then we've got problems. Now, if we do all of that and people keep coming in with bad results, then potentially they will have to lose their job. If every plane you flew crashed, then perhaps somebody needs to say something, and perhaps you shouldn't be flying.
Or you're in Al Qaeda.
Oh, you're in Al Qaeda. Yeah. Well, you tend to only do it once then, because you're pretty good at crashing.
Yeah, you can't just keep doing it.
And Another reason that numbers is, the numbers, the profit in your business is the lifeblood. It's the blood in the business. So we've got to keep it flowing. We've got to be healthy. We've got to understand that we actually need it. So ignoring it is just not an option. And often I come to businesses that are not profitable. They're not doing well, but the biggest issue is they're not looking at the numbers. They're scared of them. They think that if I look at them, it's going to make me realise that I don't have any money. I'm not making the amount of money I want to make. So, Damien, as it was recent for you, when I took you through that exercise of how much you need to have invested to retire on £50,000, how did you feel when you realised that?
I kind of already had that number in my head, to be fair.
Yeah.
I think it didn't come as a massive surprise.
Cool.
It obviously, it's a large sum of money, but is it really a large sum of money in this day and age? In the sense that there are more people's houses in the country is worth $1 million than you'd actually. So 20 years ago, it was a lot of money. Today, maybe I've been a bit blasé about it, but it's a
number, isn't it?
It's a number, yeah.
So $1 million to some people is a lot of money. $1 million to some people is not enough.
Yep.
It's petty cash to some people. They sort of spend that in a year. But for other people, they'll never see that amount of money in their lifetime.
Yeah. To me, it's just a target to shoot at.
Exactly. That's the key. That's the key. We've got to understand that the numbers that we set are really just the targets. It's the score.
Yeah.
Same as in golf. I think they said not about sort of 80% of golfers have never scored under 100 in a round of golf. Doesn't mean they can't. It's just that they've never really sort of sat down and decided that's what they want to achieve. So we've got to start thinking numbers more of it's a score system. It's an important part. It's a learning process, but we've got to learn to love looking at the numbers, because if we don't, then there's no way. I've never seen a business being able to grow beyond a certain point without really getting to grips with the numbers. You just can't do it.
I look at them too often.
Sorry?
My partner says I look at them too much.
Sometimes you can be, it can be paralysis by analysis.
Yeah.
Sometimes it can hold us back, because that's when that fear sits in. Or, well, if I spend my money, then I worry about that, and then we don't spend anything.
Yeah.
Okay, so we've got to find that right balance that helps us move forwards and not holds us back. So the next thing we've got to think about is, as we build a business, we've got to start delegating ownership of certain numbers. At the moment, for most of you, you are your business. Okay, therefore, every single number on your profit and loss account you own. Okay, you're responsible for, which is why you feel a big, heavy burden on your shoulder. As we start to grow businesses, then we need to get confidence to actually allow other people to take responsibility for the numbers. So if we look at this and say, right, the number that the shareholder owns is what in the business?
Sorry, which business is this?
So in any business, it could be your business, but it's generally easy to think of somebody else's business. So the shareholders, what numbers are they interested in?
The profit and loss.
Return on capital invested.
Sorry?
Return on capital invested.
Return on capital invested. So they've invested a chunk of money and they're interested in their return. Okay. So they get that return through dividends and value.
Value.
Yeah. So both of those figures are based on the profit. So the shareholders' value is a multiple of the profit, and the dividends is an amount of the profit that is returned. So they give the MD, the ownership of the profit. But in order to make profit, we need to generate leads. So we allocate the ownership of leads to the marketing department or the marketing director. Those leads need to be converted, which we give to the sales director. Once we've got the sale, we need to then deliver. So the cost of sales is then given to the operations director. So these three together own gross profit. Finance director generally looks after the overheads, so to make sure the costs to support the business are in order. So these four together are responsible for the net profit. Okay, the finance director is also in charge of the balance sheet, so where the money's gone. So I'll come back to that later, but they also own that. And then the HR director is really probably the only non-financial one, but that one is about the happiness of the people. So if I've got happy people, I've got control of my overheads, and efficient as I possibly can be, so I'm making the most profit, my sales and conversions are increasing and my leads are increasing, and all of those together are going to drive the profitability of my business. So when we run a small business, who's here in our business? Who's looking at our business from this position?
Sorry, which position?
So in your business right now, who sits in this seat?
The MD seat, you mean?
No, the shareholder seat.
Oh, the shareholder seat.
We can't see if you've got a pointer.
Oh, sorry.
Can't see it. It's like a Darren Brown type thing.
Yeah, I'm looking at the screen in front of me rather than the screen that over here. Right. So this screen. So in the shareholders.
Well, that'd be us.
You are. Okay. So who's looking from the position of the MD?
Us.
You. Who's looking for the position of the marketing?
Us.
Sales?
Us.
Operations?
Us.
Finance?
Us.
HR.
I'll let somebody else answer that.
Outsource that one.
This doesn't get done. You're knackered by the time you've done all of these things. So we've got to understand that this is why running a small business is so stressful. Okay, because we're looking at it from a shareholder's point of view, we're looking from an MD's point of view, we're looking at it from all of these roles. And if you can imagine, if we're trying to, if we're trying to run a high performance machine, underneath each of these, we've got another load of key performance indicators, another load of metrics that are required to run each of these. So if you're responsible for all of the numbers in the business, you just don't have enough time. You don't have enough time to do the numbers, let alone review the numbers and make decisions on the numbers. And that's why we do nothing. Because when we've got too many choices, too many things to do, then we decide, oh, I won't bother. I'll just do what I've always done. And I've always monitored it by the cash in the bank and the sales that I've done, and that's good enough for me. Okay, so if the business is staying where it is, then that's you can get away with that. You can deal with that. But if we want to build a bigger business, then we've got to actually understand what needs to go into it to achieve it. So we've got to start thinking of our businesses, and this is why we do the 90-day plans, why we're starting to have strategies around each. We're wearing different hats at different times and focusing on certain numbers. And this is a little bit like spinning plates. So we want to get one plate spinning, then we start another plate, and we get another plate, and we get another plate, and we get another plate. And after a period of time, we get, all the plates up and running, and we're handing those plates to other people to monitor. So the goal of a business, is to create shareholder wealth. Now, you can argue in today's world, a business should have a purpose as well. So a why, so we should be sort of trying to better the world, better the planet, do something great. But ultimately, if we're not making profit, if we're not increasing our value, then we're not able to do that good within society as well, because we want to be able to reinvest it. So if we look at this and say, right, well, the goal the shareholder is to drive return on investment, which we talked about. So that is down to dividend and share price. Okay, and that's a multiple of profit. So does anybody sort of track the stock exchange?
Yeah.
Yeah. So what does a typical FTSE sort of 500 PLC trade on price earnings ratio on the stock exchange? Any idea? PE ratio? No. Okay. If you get, if you type into Google, it'll come up with them. It's generally around about 15 times. Okay, so you've got a price earnings ratio of 15, PE ratio. That's how you track the performance. You've got higher ones, they're higher performing shares, lower ones, lower performing shares. So the price earnings ratio is the share price. Yeah. So it's the share price over the earnings that it makes. So if I've got 15 times, yeah, it means that my share price is 15 times my earnings. So my multiple is 15 times. That's the value my business is on. So if I want to increase that, I've got to increase, the multiple or increase the earnings. So only two ways I can actually increase my share price is to increase the multiple. So I've got more confidence in this business, it's going to drive more profits in the future, or I've got to just generate more profit. So we're always looking at those two factors. But either way, the key to it is, as we said, the game that we're actually playing is to make profit. Because without profit, I have no valuation, and therefore, 100 times 0 is still 0. Now, the exception to this is really fast growth companies like Tesla that almost trade on an infinite price earnings ratio because they've made no profit, but they're still valued at multi-billions of pounds.
Yeah, I never get that. Never get why they're valued so high when they have never made a profit.
Most of the problem is the owners, I think, Kevin.
In what way?
The Tesla owners, the actual cars themselves.
Oh, the Tesla owners?
Yeah, the owners, especially white ones. They're the worst.
You think they're the trouble, are they?
Yeah,
we're overinflating the.
Yeah. For anyone who doesn't know, Kevin's got a white Tesla.
Got a white Tesla. So I've met that sort of stereotype. Then
you're propping up the share prices.
I haven't. So perhaps I should have bought the shares earlier on. So the reason they get massive multiples is because, don't forget, it's the prediction of future profits.
Yeah.
Okay? It's not the profits now. So the multiple is, how, I pay an amount now, and will I get a return on that money in the future? So there's two things going on with once you get a publicly traded company, is because the stocks are trading all the time, they're basically valuing it on hope value for the future. So if I buy it at 15 and I think it's going to go to 20, then I'll pay 15 because I'm going to. So it doesn't matter what that base value is. I know it's going to go up. So if I buy it,
it's going to go up.
You think it's so the whole stock, the whole sort of capitalistic market is based on hope.
Yeah.
It's if you really pull it apart, it's one great big Ponzi scheme. And that's why you get these, it goes up and up and up, and then you have a bit like the crash that we had. Everything comes down again because the hope has gone, and then it gradually builds up as we get the confidence. That's why we call it the bull and bear market. Bullish market means I've got confidence. Bear means I'm running for the hills. Okay, but yeah, you're right. A 1,000 times multiple on a small profit. Well, why would I value that business? It's purely on expectations in the future. But it's a different game at that level than it is at the SME market. You're going to sell your business at somewhere between 2 and probably 10 times multiples. the majority of SMEs. Yeah, until you're publicly traded, and that's why you want to list the company, because at that point you're in a different set of valuation, different valuation model. So if we look at this and say, you know, how is business valued? Net present value of future cash flows. Okay, so that's one way. So the net present value is a value as of, you know, today's value discounted for risk in the future. So the more volatile the market is, the more volatile your business, the more risk there is. Yeah, or multiple of earnings, which is EBITDA, which is the normal way of calculating. I'm not going to go into too much detail with that for you guys at the moment, because, you know, we're sort of a long way away from that. We're still in that growth phase. Plus, there'll be a net asset value. So if you've got large assets, you know, you're asset rich in your business, then you'll add that value onto it. But holding cash will only give you a 1x multiple on your cash. If you invest that money into systems and people, that's when you'll get the multiple. Okay, so it's always better to invest your money in things that are going to improve profitability or improve longevity of your business, rather than just sitting on cash, because you only get a 1x multiple on that. So what is EBITDA? Well, you know, it's to be honest, it's net profit. Yeah, but it's earnings before interest, tax, depreciation, amortization. Okay, so the reason depreciation and amortization are taken out is because they're non-cash items. They're just writing down of assets you've bought in the future. Do you know the difference between depreciation and amortization?
Depreciation and
amortization.
I've never heard that word, so no.
Okay. No. So it's basically you depreciate tangible assets, so assets you can touch and see. So a car is a tangible asset, and you would depreciate that. You know, a building is a tangible asset, you might depreciate that. Okay. Amortization is the reduction in value of an intangible. Okay, so an intangible might be a patent. So I've bought a patent, yeah, for £10,000, and the patent's for 10 years, and therefore I'm going to amortize it over 10 years. It's exactly the same thing. Yeah, it's a reduction in the value of an asset. It's just amortization is an intangible and depreciation is a tangible asset. So you'll find that accountants use language to confuse people, yeah, so that they have the power and then you have to pay them money to do these things. Whereas if you actually know it, it's the same thing. Okay. The reason it's before taxes is because taxes are voluntary things that you pay. So you only pay tax, you know, not everybody pays tax at the same rates. So they always take, it's the company's ability to earn money, not be taxed on it, because you can do all sorts of tax schemes to reduce tax. And the reason it's done before interest is some businesses are financed heavily, yeah, and some businesses are not financed heavily. And financing, again, is an optional thing, whether you want to, you know, it's a bit like buying a house, Chris. You know, you can have a mortgage or you don't have a mortgage. The value of the house is still the value of the house, irrespective of whether you've got a loan on it. Okay, so that's the reason why it's EBITDA, earnings before interest, tax and depreciation, is because interest, tax, amortization are commercial decisions, not trading decisions. Okay, but for our businesses, we don't have massive depreciation, amortization, and therefore the easiest thing to do is just say it's net profit. Okay, so it's just that when you go into that languaging, you'll know what the difference is. So if people start to, oh, you mean net profit, and it's just easier to go from that figure. Okay, so it's basically your net profit, add back your interest and tax, depreciation, amortization, that gives you your EBITDA figure. So, but again, you know, we generally just use the net profit figure because it's just easier to calculate. So the average multiple, so this is the average multiple for on profit. So this was sort of up to 2017. So you can see here the average company is sold for about between 2 and 2.5 times profits. Yeah. Or if you want to take it as a multiple of revenue, it's around about 50% of revenue.
Actually, quite a small figure then. Two times. Yeah.
Yeah.
Not much, is it?
Again, this is the average. So this means some businesses are going for nothing to 1 times, and some businesses are going 3 to 5 times. Obviously,
sorry, this is slightly off track, Kevin, but just quick steps that easy steps that you can take to increase that multiplier then, obviously without going to a PLC.
I'm coming on to that.
Right.
Okay. So obviously one is to increase the profit, but we can have more of an impact if we increase the multiplier. So if we can get that multiplier from 2 to 5, that's like increasing your profits by 3 times. So is it easier to take your profits from 100,000 to 300,000, or is it better to have a multiple from 2 to 5? Okay, but if you can do both, then you'll get a double whammy. You'll get an increase in profit and an increase in multiplier, and you'll do that much better. So if we look at the multiplier, so the average business, is around about here, and this was a system I used to use, which is called Value Builder. It's about increasing this multiple as high as we possibly can. So really the way that we improve the multiplier is the Action Coach 6 steps. This is why it was built. Mastery level of getting your finances in order, your time management, so the business isn't reliant on you. Delivery mastery, consistently great quality products and service. Those are all key. How systemized your income streams are. So, does your income stream go up and down, or is it coming on a regular basis? Is it guaranteed for the future? So if you've got a strong sales and marketing machine that's constantly bringing new business, your multiplier is going to go up. If you've got a well-defined niche, if you've got a brand that has value, if you've trademarked it, it's going to increase your multiplier. Okay, so don't forget, you're looking at how secure is this income and this profit into the future. So that's your multipliers down there, your EBITDA's there. Leverage system is systemization of business. So how reliant are you on quality systems? So Damien, we're talking about moving you from spreadsheets into accounts packages. That's going to improve your multiplier, because if I've got to go and learn a spreadsheet that's bespoke to you, it's not going to happen, and my numbers aren't going to be there. If I've got a CRM system, if I've got a stock control system, if I've got an account system, if I've got reporting that comes out at a touch of a button, I'm going to understand more where my business is, and that's going to improve the multiplier. Have I got a great team? So if I was to interview your team, are they A grade players? Or am I going to have to sack them all and replace them all? If I keep them all in their A grade, then it's going to increase the multiplier. Okay, and synergy level, which is about the business working without you. Then again, it's if the business works without you, you don't have to be there. If I'm going to buy your business, I'm going to pay you more than if I was to actually have to keep you on to hand things over to me. So that's going to increase the multiplier. And ultimately, the results diversification. So are we able to acquire more businesses? Can we do vertical integration? Can we go into multiple businesses? Then again, that would then do both. It will increase our multiple because I'm now bigger, and the EBITDA figure because I've got more profit. Okay, so everything that we do in our 90-day plans we've got to be thinking, is this increasing my profit? Is this increasing my multiple? If it can do both, then great. That's a really good strategy to have. So we're always looking to build things that are going to help us into the future. Any questions on that? I know it's a big topic in its own right, and I've sort of glossed over it at this stage because, say, it's not totally relevant for where you guys are because we're not looking to sell in the next couple of years. But as you get closer to this, it will become more important. But the key to think about is the whole of the Action Coach system was built around improving the valuation of the business. Because if you remember back when before Brad started Action Coach, he would buy businesses for a low figure, so for a 1 or 2 times multiple, come in, do what he did over the course of a year, 2 years, and then sell for a higher figure. So it wasn't about building businesses for other people. This was about him flipping businesses, buying businesses low, building them up, putting these processes in place, making them more profitable, making them more attractive, not ever getting involved in them. He never worked in any of his businesses, and then selling it on to another party. Same as you guys are doing with houses. You know, I buy a derelict house, yeah, I do it up, I add value to it, I then flip it, I then sell it. Okay, so before we even did this, that was, you know, how the whole Action Coach system was built on, and that's why it works so well with this model. So looking now to actually start measuring in more detail. So the first thing we've got to look at is the different areas of the business that we're measuring. So the first area that we really want to look at is the financial side. Yeah, so what are our key financial areas to focus on? And these are my sort of top 6. Okay, so from wherever we are, there's 6 things we need to be on top of. The first one is a regular bank reconciliation. Now, I know that if you're using Xero and the modern accounts packages, it does it automatically for you. Yeah. If you're still doing it manually, then okay, you've just got to check every week, you know, have I got in my system the numbers that the bank shows? Yeah, we cannot wait a quarter, a month to do a bank reconciliation. You know, the bank is the reflection of money in, money out. So we've got to make sure that's happening. Okay, so I'm assuming you'll look at your bank statements on a regular basis and agree that back to your accounts. You know, even if it's on a spreadsheet, you're making sure everything in there is reflected correctly in your account systems. Once we've got that, then really the next sort of step up from that is a weekly cash flow. So we're just short term looking at how much cash is coming in, going out from the business. Now that can be a fag packet, it can be a spreadsheet, but we really want to keep track of, you know, on a week by week basis where the cash is. Now, ideally, we want to be projecting that out a month to 3 months ahead. And how you keep track of it really depends on how your money comes in. So if your money comes in, you know, once a month, then I would do like a 3-month rolling cash flow. If it's a weekly business, so if we're selling stuff like Chris does on a weekly basis, then I'd be looking at probably a 12-week weekly cash flow. Okay, so always gear your money, your period in which you're monitoring your cash flow to the actual frequency that the money comes in and comes out. Okay, but it's, you know, weeklies, yeah, if cash is coming in and out regularly, yeah, on a weekly basis, monthly if it's coming on a monthly basis. The next factor that we've got to look at is our aged debtors and creditors list. Okay, we must always be looking at our debtor book. Now, if we don't sell on credit, you know, Chris, most of your stuff is cash, isn't it? So your debtor book is 0. For, you know, Ranjit, you know, Brian, Damien, you know, you're selling on credit. We should always be looking at where our debtors position is, because where our money's gone is really key. You know, basically our debtors is money we've lent out to our clients. Okay, and if you look at any money lending person, they keep a close tab on the amount of money they've lent out. And if you're a day late in payment of a loan, what would the finance company do?
Fine you for it.
Fine you for, or certainly
Put a charge on it.
would charge you, would certainly make contact with you and say, hang on a minute, why are you late paying? Now, unfortunately, we're in a world where it seems to be okay, for people to pay late. Certainly some industries are worse than others. Anything in building, it's like an unwritten rule that, we can pay late. But you get treated how you allow people to treat you. Sometimes we have to be a little bit harder to actually pull that money in. And I always say, he who shouts loudest gets paid first. Yeah, and I've seen it so many times. The person that gets stung for a bad debt is the person that has been nice and has let people get away with, he's a nice guy and, he's a friend, he's always paid, and you just give him a little bit more time, and then you're the one that gets burnt. Everyone else has got paid. All the bastards that have shouted have got paid, and you, nice person, don't get paid. So we've got to make sure we've got that debtor process going that, once it gets, and I say today's world with COVID, we don't want to be nasty. We want to listen to people, but, and be flexible. If somebody says, look, I've got cash flow problems, can I pay over a period of time? Yeah, fine. Come up with a system that works. Okay. But they've got to understand they are borrowing your money. Anything over 30 days is that's an interest-free, security-free loan. And because they can't get it from the bank, of course they'll take it from you. So debtors and creditors is key at least on a monthly basis, if not looking at on a weekly basis. Then we've got to have our profit and loss account. So this is our income and expenditure and our balance sheet. And then the final one would be our budgets. So we're now setting budgets and forecasts going forwards. So those are my sort of key 6. If we're not doing that, we do not have financial mastery. Yeah. Once we've got those, then we can go into more granular, more detail as we go through. So if we look at the bank rec, for those that are sort of a bit unsure what it actually is, it's the balance per the bank statement, had any bankings received but not credited, less any payments raised but not debited. Now, in the old days, when you used to pay money in through a paying in slip, or cash, and you wrote money out by checks, there was always a delay between getting the money and it actually hitting the bank account. In today's world of backs and payments, it's almost irrelevant these days. Okay, everything, as soon as you do a payment, it's reflected in your bank account. As soon as you receive a payment, it's reflected in your bank account. But just be aware that sometimes when there's check payments or there's a delay overseas stuff, there can be a delay in it. The other interesting to think about is, when you've got money in your bank account, what would you say your account is in? Is it in credit or is it in debit? So you get your bank statement through and it says, I've got £10,000 in my bank account. Is my bank account in credit or is it my bank account in debit?
Traditionally, you'd say it's in credit.
It's in credit. Yeah. My bank. So I've got money in my bank and it's a credit. Yeah. When you look at your own trial balance or your own accounts and you've got money in your account, is the money a debit or a credit?
Actually, in the bank account, it should be in credit.
In the bank, on the bank statements in credit.
If you're, what I'm saying is, if your accounts are matching the bank statement,
yeah,
then exactly the same, in theory, should be in credit because you've not taken out anything you got going out yet.
Correct. So when you look at your balance sheet in your accounts, and you look at the £10,000 that you've got sitting in your bank account, yeah. Has anybody got a balance sheet to hand they can quickly look at?
Yeah. Yes, I'm looking at mine.
Okay, so is your amount in your bank account, you have to tell us how much it is, but is the amount in your bank account a debit or a credit?
Where is this? Yeah, it says current assets.
Current
Account.
assets. Yep.
Yep. And it says total cash and bank in hand.
Cool. So you've got money in your account, which will be in your current assets, which will be a debit on your accounts.
Mm-hmm.
Yeah. Yet when you talk to the bank, when you look at a bank statement, it will say it's in credit.
Mm.
Now, the reason is because the bank statement is the bank's position.
Mm.
So you are a creditor to the bank because you've given the bank £10,000. So the bank owes you £10,000. So you're a creditor, which is why it's a credit on your bank statement. In your accounts, it's a debit, which is a loan, in effect, a loan to the bank. Okay, so it's just something that catches people out when they say, I'm in credit. Well, you're not in credit, you're in debit, or you're in debit and you're in credit. It's because a bank statement is the mirror image. It's a reflection of their position, not your position. Okay, if it's not quite clear, it should become clear when I talk to you about the balance sheet. So the weekly cash flow is just as simple as that. It's an opening bank balance, cash in, cash out, closing bank balance. Okay, now that will be as of we are at the moment, and then potentially projected forward. So I'm projecting forward each week, each month, how much money I think is going to come in, how much money is going to go out, and my projected bank balance. So this is where most people sort of run their businesses: is cash in, cash out, and as long as I've got money in the bank, I'm happy. Okay, so we need that because cash is king, but if that's all we're reliant on, then it can hold us back, and we're not really getting into the detail of what we need to within our accounts. If we want to increase cash, okay, so cash is king. Yeah, these are my sort of key ways to actually get money into the business. Number one is put your prices up. Okay, if you can put your prices up, that money you put on top goes straight into your back pocket. Okay, it's you don't have to do anything. There's no cost to doing that. You just need to think about putting your prices up. Another way to do it is to reduce your debtors. So if you have got money that's owed, call it in, chase it, get that money in, because it's no good to having the money outside of your business. You need it in your hands. If you're running stock, now I don't think any of you guys run stock, but if you were to run stock, then reduce stock levels. Because again, that's money that's just tied up in materials, not in cash. You might have assets that have been sitting around doing nothing. Sell them. Clear them out. Okay. If they're not earning you money, then they're not an asset. And too many people sort of, and we're talking to you on this one, Chris. So yours is a little bit between these two with stock cars. So Chris does second-hand cars. We know that our target is to turn around a car in how long, Chris?
Ideally, sub 30 days.
Within 30 days. So if he's got a car that is been sitting on his forecourt for more than 30 days, yeah, it's cash that's sitting there not moving. Now, the problem you've got, if you've got a car that isn't moving at a certain price, yeah, what's your fear, Chris? You don't want to sell it for less because
it's a fear of loss, and also you have to admit to yourself that you got it wrong in what you bought.
Yeah, Cool. So suddenly the emotions kicking in again. Yeah, I fucked up. I did it wrong. No one likes to admit that they're wrong, and therefore, if I don't sell that car, I
You're
don't
not
have.
realising the loss. No.
I'm not realising the loss, so I haven't made that mistake.
And the fear of loss is much more powerful than the fear of gain.
Correct. Yeah. Whereas what we're trying to do is say, look, this is a numbers game. You know, if we sell that even at a loss, and I buy another car, and I can turn that in 30 days, then I've now turned that. I'm regaining that loss that I've made.
And every time I do that and liquidate stock and go and buy something else, every time something positive comes of it, but I still find it hard. I'm getting better, but I still find it hard to liquidate the stock at a loss or a small profit to then move on. So.
Yeah. And the hardest thing is where you've got a non-depreciating. I know it does depreciate, but it still seems to have the same value today as it did yesterday. So I learned this one the hard way when we were importing or we were selling daffodils. So if you know, all of the daffodils in the UK are actually grown in the UK. So they start in Cornwall, and then through the season it moves up to Scotland. So it runs from around about February time through to Easter. And you cannot sell a daffodil after Easter. Okay, just, no one will buy a daffodil after Easter. So depending where Easter is, depicts your season. But daffodils are, they're a hardy thing. So when the weather is cold, they don't grow. So when it hits a certain temperature, they start to grow, and they grow really quickly. And as soon as they hit a certain temperature, they flower. So you can cut them when they're close. You put them in a cold store, and then you take them out of the cold store, and then they bloom. But so you've got about a 2-week window before they start to degenerate once they've been cut. So, and we're trying to put the market for daffodils goes up and down. I mean, it's a crazy market. It's sort of the Dutch flower auction, and so the prices. So you've cut them. You're trying to sell them on to supermarkets at fixed prices. So there's all this sort of playing with these with the values. And then, but if the market goes the wrong way, you tend to hold the stock. But if the market doesn't catch up, you end up with more and more old stock. But there's a fear that I can't get rid of this because I've paid for it. I've paid, 10p a stem for these things. Yeah. So you hang on to it and hang on to it and hang on to it. And we had one situation where the general manager refused to realise his loss, and we lost about £550,000 because he held on to it, and then Easter came, got closer and closer, and then we couldn't sell that volume of flowers in the period we had left. And as soon as Easter's gone, you just bin them. Whereas if we'd bin them earlier, we would have had a smaller loss, but we wouldn't have had all the stock losses and the labour losses of actually making up on our mistake. And that's the worst thing you can do, is you start chasing the losses, rather than just accepting that the loss is a loss. Great. All I've got to do now is to actually make more money. Okay. So if, I know most of you guys are sort of, not into stock, but that can be a big one. So reduce cost of sales, reduce the overheads. And the other way to get money into a business is to borrow. Okay, sometimes we do have to borrow, and there's good debt and bad debt. So we borrow if borrowing is going to generate us money. We don't borrow to cover overheads unless it's a short-term fix. Okay, so if you're borrowing to buy a machine, to invest in a person, to invest in something that's going to make money, that's fine. But if we're just borrowing to pay the bills, then we've got to be very careful with that. Okay, you can do it short term to get you through a small hole, but you've got to have a clear plan on the other side of how you're going to come out of it. So aged debtors, who owes what, how long they're outstanding, avoid bad debts. I think I've got an example of an age debt report here. So again, if we've got account systems, they will produce these at a touch of a button. Okay, so we know who owes what, how many days it's outstanding, what the balance is, and we can start to calculate things like debtor days. So the debts at the end of the month times the turnover, so we can keep track. So if you've got a debtor days of 60 days, it means you're giving 2 months credit. Now, if your term say 30 days, then you're allowing everybody twice the amount of time to pay. So I would say you need to tighten up to get more cash into the business. So key thing to this is, be on top of it, make sure you invoice on time. So don't delay on invoicing, get them done really quickly. Control outgoing payments. So, while we want to get money in, you can be sort of flexible on who you pay. And again, it's amazing if you look at, if I said to you, he who shouts loudest gets paid first, think of how many of your suppliers, which ones of those shout. How good is their debt collection process? I mean, it's amazing how poor a lot of them actually are. But the ones that do shout are generally the ones you pay. It's not you're a bad payer. It's just that we tend to wait for something to happen before we pay it. And if you give 1 extra month's credit, with an overdraft, so if you're running an overdraft that's you're paying interest on, even in your bounce back loan, it's slightly less, but it's costing you, £600 a month for every £100,000 you lend. So if your debtor book is 200,000, you're wasting £1,200 a month in finance fees to fund your customers. Okay, so if you're lending money, there's always a cost to it. Even if you've got money in the account, you're not using that money to actually earn more money because you don't have it. So we're always looking at ways to bring more money into the business. So then we look at our profit and loss account. So this is sort of the real core of the numbers. So very simply, if I looked at this, it's profit and loss account is the sales that I've had in the period, the cost of sales, so that's the direct costs. This is our gross margin, less our overheads, which are our fixed costs. That gives our net profit. Okay, so our net profit. So any P&L account from your business, Brian, up to ICI's business, they are all exactly the same. There's more information in between, but you can boil it down into, what was my revenue? What were my costs of producing those sales? What was the margin as a result of that, the overheads and the net profit? Okay, so a way I show that in a bit more detail is, like this. So this is what I generally find as a shareholder, as an MD, this is all I'm interested in. I want to know my total sales. I want to know my direct costs, generally broken down between labour and direct costs, which is my gross profit. I'll have a gross profit percentage in there because that's what I should be building into my costings. And I've got my salaries, my cost of running the office, sales and marketing, finance and admin, and then all of that comes down to my net profit. So are there any terms in there that anyone doesn't understand? So please, this is a time to ask questions. There's no wrong questions here. Some of you are more au fait with the numbers than others. But are there any terms in there that you don't understand or you're not sure what would be in that particular cost center?
Right.
You happy with Brian? Damien?
Yeah, I'm happy.
You good with that, Brian? Makes sense? Cool. So next level down then is drilling down into a bit more detail. So now we're starting to look at the cost of sales breakdown. So now we want to go down into more granular. We want to know what sort of products we're selling. So these are the products that we're selling here. these are the revenues that we're getting, and therefore we're now starting to calculate our average transaction value. Okay, so we're starting to looking at cost, profit centers, types of product that we're selling. Yeah, it might even be customers. It could be, customer A, customer B, customer C. But we're starting to dig down into more detail here. So what are the units? I want to know not just the total sales. I want to know how many units of each item I'm selling, how much I'm selling it for, what's the revenue I'm going to get for that, and my cost of sales per unit, the packaging, carriage, other sundry costs, and then my labor. Okay, so this is where we're really looking into that more granular side of things. Now, for you, Damien, it's going to be predominantly labor costs in here. Yeah. Brian, you're going to have part costs in yours as well. Ranjit is more labor. Chris is obviously more complicated because he's got the cost of the vehicle, and then the cost of those of actually bringing the vehicle ready for sale in his direct costs.
What do you do with so obviously a lot of my costs, well, much like most people, something like an office or software isn't necessarily related to one particular project. It's just that's a high level overhead.
Correct. So I would always say your cost of sales, your direct costs, are exclusively attributable to a sale in that month. So if you had no sales, there'd be no cost.
Right, but you obviously do have a cost because you've got to pay, you've got a public liability insurance, all that kind of stuff.
No, because I would say, so that to me would be in your overheads. So if we go down to this level here, so your overheads here of running the business, whether I do one sale or no sales will be the same. So a lot of these costs will just come in here.
Right, okay. Yeah, no, I get you now.
Okay, the one that is slightly different is labor.
Yep.
Okay, because you could argue if I have no sales, I've still got to pay my wages bill.
Yeah.
Okay, and this is where you can make the call, but I tend to like to see the big ticket numbers, the ones that are important above the line, above the gross profit line, and the less important ones below. And to me, labor is such an important one for a service-based business. It should be above the line. Okay, so for you, Keith's labor is a direct cost.
Yes.
Whether he's working or not, it's still directly, because if you had no work, you wouldn't have Keith.
Well, I'd have to make him redundant.
You make him redundant, yeah. Whereas if you were still trading, you would still need public liability insurance.
Yes.
Okay, you would still need an office. Okay, it wouldn't be as big an office, but you would still need an office. Okay, so there's costs that support the business, and then there's costs that are so in effect, if anything touches or goes into an invoice that you're invoicing, then I would put that as direct costs. Yeah, anything else can come as overheads. There's no right and ready rules with this. As long as you're consistent and it makes sense, then it's okay. But what can happen, as you sort of start to grow, because at the moment, you probably say, well, 80% of your time is up here in the direct cost because you are chargeable, you charge yourself out, and 20% maybe is an overhead. It's to run the business, do the accounts, do the sales and marketing. So you could allocate your cost between the two centers. Okay, it goes to, you're getting quite detailed when you do that, but as long as you're consistent, it sort of doesn't matter. Okay, so that really is, that's all a profit and loss account is. It's matching the income to the expenditure. So, my sales of 250,000 in January, I had £120,000 of direct costs associated with that. So I made a contribution or a gross profit of 129. It cost me 120,000 to run the business, and therefore I made an £8,000 profit. And then we track that on a month by month basis. Okay, and we can have more detail if we need to down to that level. But ultimately, as the shareholder managing director, that's what I'm interested in. As the operations director, that's what I'm interested in. As the finance director, that's what I'm interested in. Okay, so when you're doing all the roles, then we need to see all of those. Any other questions on profit and loss? I think most people sort of, that's the one statement they do, and it's generally the easy one. The more complicated one is the balance sheet, which is what Brian asked. So if you think about the profit and loss account as a video, so it's a video of what's happened in the month. So all the transactions in the month, you know, it's like the stream flowing through. A balance sheet is a snapshot. It's like a picture. So during the month, money's coming in your business, going out your business. It's moving all around, and then at the month end you go, right, freeze, stop. Where's the money? Because if I said to you right now, where, you know, all that money that's come in and out of your businesses over the last month, how much of that have you got in your pocket right now? How much of it can you physically touch right now? Chris has probably got hundreds of thousands in his pocket.
I've got a big pocket.
But how much of your cash has come in and out of your business have you got in your pocket right now?
I can tell you the balance sheet is two.
No, cash in your pocket right now.
Cash at bank.
No, cash in your pocket. Actually, pound notes that you can actually hold on to.
Sorry, we're talking personally or business?
Of business money.
Yeah.
So all the money that's come into your business in the last month and gone out of your business, how much physical pound notes, cash, can you actually touch right now?
46,000 cash at bank.
No, that's it. That's in the bank. Cash in pound notes.
Right. Okay.
So I've got.
I think there's probably a couple of grand in the safe, I'd imagine.
A couple of grand in the safe.
Yeah.
Okay. So is your business?
Sorry, I didn't understand the question.
So is your business? You know, is that all the cash that is around? So is that the only asset that you've got? No.
No.
Okay. So the money's come in, it's gone out, and you say stop right now. There's £2,000 you can put your hands on right now. Everything else is somewhere else.
Yeah, either in the bank account or in stock or whatever.
Okay. So the balance sheet is a snapshot of where that money is, where the money's gone, and where's it come from. So this is why we have debits and credits. So a debit is where the money's gone, so it's left your hand and gone somewhere. And credit is where has the money come from, so it's come into the business. So money in, if I can draw here. So money coming in, money going out. And that's all accounts are, is a record of money in, money out. Now, what I say to you about the bank, when you've got money in credit, because from the bank's point of view, it's money from you, money from Brian. It's in the bank's account. That's why it's a credit. For you, it's gone somewhere. It's gone to the bank, which is why the bank sits over here. Okay, so when we look at this, where our money goes, we can put our money into assets, fixed assets, land, buildings, plant equipment, computers, desks. Damon, you built your office. So money's left my hand, and has gone into those assets. It can also go into current assets. So fixed assets are assets that are going to last more than 1 year. Current assets are generally assets that sort of change over the course of a year. So they're shorter term assets. So stock, I can lend money to my debtors. I can put money into my bank accounts. There's a thing called prepayments, and I can lend money to other people. So it's not in Chris's safe. It's not the £2,000 in his safe. It's gone somewhere else. It's gone into a bank account. It's gone to my debtors. It's gone into assets. It's left my hands and gone somewhere else. Okay, so those are all debits, yeah, and they are generally, when we look at a balance sheet, at the top of the balance sheet. Then, where's the money come from? So money can come from borrowing, which is liabilities, from the overdraft, from my creditors. I've borrowed from them, I haven't paid them yet. I can borrow money from the VAT man, from the PAYE office. I can have loans and accruals. Again, they're like prepayments. I'll talk about those in a bit. Or they can come from the money I've put into the business, so shareholder equity, or profits that I've actually generated. Okay, so the balance of my income, which is money coming in, which is a credit, and my expenses, which is a debit, which is money going out, leaves me a profit, yeah, which would be part of my owner's equity that I've left in the business. So I haven't taken it out as a dividend, I've left it in there to finance the running of the business. So that is really all a balance sheet is. It's just a statement of where the money's gone, where it's come from, where it's gone at any point in time. So when I do a balance sheet, I always need to compare it to another period. Because in isolation, if I look at one picture, well, it tells me something, but you know, if I took a picture of Chris now, it would tell me how Chris looks now. If I'd taken a picture of Chris 20 years ago when he had hair, yeah,
you're going to make me cry.
I could then see the difference and say, "Blimey, Chris, you know, you've improved with age, mate." So I've got to compare it to something. So we either need to look at a balance sheet compared to last month or a future month. Sorry, last month, last year. Yeah.
And you recommend doing that monthly?
Monthly.
Yeah.
Yeah.
Cool.
Now, another reason that you and this is more important when you've got somebody else doing your accounts for you, why you should always have a monthly profit and loss and a balance sheet, and you've got to have both statements, because a balance sheet is like a carpet where you can sweep crap into. So if I've got a profit in my profit and loss account, okay, and I'm showing £100,000 profit in my profit and loss account, and I feel that's really good, isn't it? Yeah, but I've got £500,000 of overdue debtors who aren't going to pay me. Yeah, if I don't know that, then I'm going to think everything's great, but actually, because my debtors aren't paying me, I'm going to have to write that debt off at some stage. So my £100,000 profit is then going to become a £400,000 loss. If I've got £1 million of stock that I can't sell, at some point I'm going to have to write that off, and it's going to affect my profit. Okay, so clever accountants sweep things under the carpet in the balance sheet. Now, the good thing is a balance sheet always has to balance, so they have to hide it somewhere. Yeah, so it's always there. It's just sometimes you've got to go and find it. Okay, that's why you always need to look at a balance sheet with your profit and loss account. It generally doesn't take long to look at it, but you're looking for the lump in the carpet. Yeah, where's the number that wasn't there last time? Why is it there? Why is that number there? You don't have to understand how it got there. Yeah, you just got to be able to ask the question, and then your accountant should be able to give you a decent answer. But I've seen more businesses go bust because they weren't looking at this. I had one company that the accountant was showing them every month a profit, and they thought they were doing really well. And then one day the VAT man knocked at the door and said, "You owe me £150,000 of VAT." They went, "Well, we can't do. You know, we pay all our VAT on time." I said, "No." So the accountant had been falsifying the profit and loss account because he didn't want to give them bad news by manipulating the balance sheet. And because they never looked at the balance sheet, they never saw it, and the business went pop. Okay, so we've got to always, always look at a balance sheet as well as the profit and loss account. Number 6 then is a budget. So up to now, everything we've done is looking backwards. So the profit and loss account is looking backwards, aged debtors is looking backwards, balance sheet is looking backwards. At some point, we've got to start trying to look forwards, trying to predict where we're going to go. So what should be in our predicted profit and loss account? So pragmatic view of what the business can do. Scenarios. So what if we increase sales by 50%? What if we increased it by 200%? We use it to set targets for ourselves, but also for our team. You know, so once we've got team, we can start setting sales targets. Always think that a budget is a stick in the ground. Okay, it's not an absolute. Yes, we're trying to predict the future, and the future is uncertain, certainly now. But if we don't put something in the ground, we've got nothing to compare where we're going to. As I said before, if I made £1 million profit, is that good or bad? No idea. Compared to what? Compared to last year, which was 500,000, it's good. Compared to a budget of 2 million, it's not so good. Okay, so we've always got to have something we can compare. If we're trying to borrow money, yeah, we've got to be able to show any lender what we think is going to happen into the future. So if we want to borrow money, so certainly, I mean, the bounce back loan was, you know, very easy because you didn't need this. But if you were going for a Sybil's loan, so over 50,000, you had to have a budget to show that you could repay the money in the future. And to be honest, why would you borrow money if you weren't sure how you're going to repay it? The bounce back was different because I just said to people, just take it and then worry about that later because you don't have to repay it until next year. But if we're borrowing, you know, to actually invest, we've got to do a prediction of where it's going to be. And the other thing is it sets your reticular activating system. Okay, if you set a budget of, you know, a bit like we were doing on Wednesday, Damien, we sort of set that £1 million goal, didn't we, for 10 years? Yeah, then we came back to 500,000, 350. So now I'm setting your reticular activating system. All right, that's where I'm going to go. So now I should start to see the opportunities to help me get there. Okay, now a lot of people see budgets as negative things. Oh, I've got to keep to the budget and I can't predict. You know, it's to me, it's a liberating thing. We should always be setting our targets where we want to go. And if we get to the end of the year and we haven't achieved it, fine. Okay, we haven't achieved it. As long as we've done everything in our power to achieve it, then that's still okay. So break even, I'm just going to flip through this quite quickly. But when we look at our break even, we're looking at our fixed costs, our variable. So our fixed costs are our overheads. You know, I said about accountants having more than one word for the same thing. So a fixed cost and overheads are sort of the same thing. Variable costs, direct costs are the same thing. So this is our revenue up here. Okay, so this is our revenue. Here's our fixed costs. Here's our variable costs. So up here, I think I've got you. So down here is a loss, and up here is a profit. So at this point here, okay, so we know here we've got to sell 15 units in order to break even, or £1 million of sales is our break even figure. So if we don't achieve this, then we're in loss making. If we achieve this, we're in. Every business should know what its break even is. So in effect, how many hours do you need to work in a week before you've actually covered your fixed costs? So are you working till Wednesday before you make a profit? So Thursday, Friday are profit days, yeah, or you work until Friday afternoon to make a profit?
So the x-axis is the units.
So that's the units, yeah. So that's the number of units, and then that's the amount, and that's the units.
Yeah.
So I've got to sell 15 units to make £1 million to cover my fixed costs and my variable costs. If I
Yeah.
sell more than 15 units, then I'm in money. Yeah, if I sell less than 15 units, I'm losing money. So you're a service-based business. So Chris knows he needs to sell how many cars, Chris, to break even?
As decrease, it's about, at the moment, it's about 12 cars because the profit per unit is increased. But
Okay.
Across the last 12 months, it's 20 cars to break.
About 20 cars, yeah.
Yeah.
So, and if you can create more profit, then you can do less cars.
Yeah, that's what's happened recently. Less
So-
cars.
So that's what I said about increasing prices.
Yeah.
Then you don't have to do as much work. So if you're in labour, so for you guys that are selling services, this would be hours. So this would be number of hours I need to work in order to break even. So if I'm doing 15 hours at £50 an hour, that gives me my turnover. So that'd be 750 quid, wouldn't it? Yeah. So I'm starting to work out. So if I have to do 15 hours a week before I break even, that means I've got to work half the week. So if I've got less than 15 hours chargeable work, I'll lose money. If I've got more than 15 hours work, I should make money. And then what happens is when we bring in another fixed cost, so let's say we bring in another person, that this steps up. Okay, so this goes up. Yeah. And then we're back here is this is loss making until we can get the units up from 17 to 22. So let's say that was hours again. So I've got to create another 5 hours of work for that person to actually for us to break even again. But once I've done that, that should allow my revenue to go higher so that the profit that I make here is more than my profit that I was making before I invested in that extra cost. Okay, and this is why budgets are so important, because the budget is the way that you predict how that break even changes and when I need to bring in a new cost. So it's really key to understand both. So fixed and variable costs, fixed expenses, I think I explained. Those expenses you pay whether you have sales or not, variable are those that vary with the sales. And if you want to calculate your break even, it's your overheads, so your fixed cost divided by your gross profit percentage, your gross margin percentage. So if you're running at 50% margin and your overheads are 100,000, you've got to do 200,000 of sales. Okay, so again, this is why you've got to know your P&L figures to actually be able to calculate that. So those really are your finance KPIs. Okay, they're generally the ones that most people keep. Yeah, and they're sort of the easiest. I say the easiest ones. They're the ones that most accounting systems are geared up for you to do. But you've got to understand that you need the cash flow, the profit and loss, the balance sheet. Then you go down into more detail in your sort of key performance indicators, and now you're looking at per department. So the first one is your sales and marketing. Okay, so at the top of the funnel, how many leads am I actually pulling in? So how many leads do I generate on a day-to-day basis? What my conversion rate of those leads are? So how many do I qualify out? How many do I actually qualify in? What's my conversion rate to a sale? And ultimately, how many pop out the bottom end? So we're starting to look right the way through, and probably the easiest way to see that is, it's basically the 5 ways. So how many leads do I get? What's my conversion rate? How many transactions do I do? What's my number of transactions? What are my revenues, margins, and profit? Okay, these are all the key things that we need to have in place to actually get our numbers right. So in our sales, the mantra pretty much is measure as much as you can, because it's always useful to know where you are with these numbers. Once we know our sales and marketing, then our operational is really about on time, on budget, on spec. So Are we measuring the time that goes into our work, a job? Yeah. Are we measuring the costs that go into it? And is our quality specification right? So we're starting to look in on operational, what are our operational numbers? So have I got, you know, what are my limited resources? You know, for service based, it's the number of hours you've got. So therefore you should be looking at the number of hours that go into a product, into a job. You know, time, machine, people. If you're producing things, it'll be materials. You know, Chris, for you, it's space. You know, you've only got so much space. So what's your turnover per square foot? Can you get your turnover per square foot up? The way you do that is you sell more cars more quickly. So operational, there should be a rate per something or other, a unit per hour, something that's measurable within the business on the throughput, okay, based on the resources you've got. And the more we can, again, the more we can monitor that, the more information we've got, the more decisions, you know, positive decisions we can make. And we're really thinking about this marginal gain philosophy of, you know, if I can improve all of those numbers by 10%, yeah, if I can improve 100 areas by 10 or 100 areas by 1%, that gives me 100% improvement. But often we get this marginal gain of a percentage on a percentage on a percentage. So we need to break down everything we do into smaller bits, measure them, add them together, and improve them. Okay, so, you know, for a lot of us, it's not, you know, we're still at that sort of P&L balance sheet stage first, but once we've got to that, then we're breaking things down into more detailed area. And then the people side of things, you know, how do we measure our people? You know, sick leave, absenteeism, happiness levels, appraisement. These are all things that, as you build teams, that you can start putting measurements into place. Okay, so everything in the business can be measured. Sometimes it's a subjective measurement on a score out of 1 to 10. How do we score ourselves? Sometimes it's a substantive, you know, it's a real number. Doesn't matter what it is. If we can turn it into a number, then we can measure it and therefore we can improve it. So shareholders, you know, again, we go back to here, shareholders MD own the profit and value of the business, marketing leads, sales conversion, operations, gross profit. Start to see how this all comes together. So as we build the business, you know, we're starting to, everyone has ownership of a particular area. So now, because, you know, you've got small teams, you can't measure everything. It's just too much to get into. We've got to start somewhere, get that plate spinning before we move on to the next one. So often with this, you know, it's like a car. You don't need to know how to do accounts. You know, Xero these days does most of the work for you. Okay, but you've got to be able to read what comes out of it in order to make better decisions to move the business forwards. Okay, this is why you've got to learn to love your numbers. You know, your numbers are your best friend. They're not emotional. You talk to somebody, you know, one of your team members, you know, and say, how's things going? They're going to give you an emotional answer to that. You look at the numbers, they're just going to give you a factual answer to it. And for me, I'd much rather go from the factual, logical thing than an emotional decision. And same for us. You emotionally, you'll have a good week and a bad week. Yeah, the numbers will always just be the numbers. So we've got to learn to love them, learn to use them, learn to report them, you know, and then, you know, do something with them. There's no point in measuring something if you're not going to take action on it. Okay, it's just it goes back to that wall I said about the green dials and the red dials. You know, there's no point in having a wall full of green dials. It's pointless. You know, just it feeds your ego, makes you feel good, but doesn't actually help you improve. You want some red dials on there so that you can say, right, that's the area I'm going to improve this month. And that goes into your 90-day plan. So home fun. Number one, we've got to have a budget. Okay, so a forecast of our income and expenditure going forwards. Your P&L accounts and your balance sheets must be up to date. You must be reporting them on a monthly basis. You must be looking at them. Okay, so I'd say at a minimum, you've got those. If you've got those already in place, then have a think about your limiting beliefs. You know, is there something about money, about numbers that's potentially holding you back? And you know, start to set your dashboard, and think about your dashboard as it's a little bit like an aeroplane. If you're flying a glider, does anybody fly gliders? Flown a glider?
No.
No. So if you fly a glider, how many dials do you think you've got in a glider? Two. Yeah, which are
Altitude and speed.
airspeed and altitude. Okay, so if you're just flying a glider and you just go up, you go around, you come back down to where you started, that's all you need. So that to me is sales and cash. Yeah, so if you just want to stay where you are, fly around, not go anywhere, then all you need to look at is how much sales have I got coming, how much cash have I got in the bank. Now, if you're flying a jumbo jet and you're carrying 400 passengers, how many dials have you now got?
Lots.
Lots. Okay. Now, are you looking at all the dials all the time?
No.
No. You're still looking at the key ones. So sales and cash is still key, and then you'll have a few others. Yeah, but you'll have other people. Your co-pilot will be looking at some, and some will just have warning signs. You'll only notice them when they go beep. Okay, and that's what we want to start to think. We're creating a dashboard that we're looking at the things that we want to monitor, but things that are in the background will beep at us when they go wrong. Okay, then we can start really getting into the marginal gains and saying, right, this month we're going to improve lead generation. So let's really get into the lead generation numbers. Let's look at the operations numbers. Let's look at the cash flow numbers. Yeah, and we look into more detail, then we come up with strategies of how we're going to improve them. So, cool. So, any questions from that? So, Damien, what's anything that?
No questions. I'm gonna make an effort to do a profits and loss account and probably date it back to the beginning of my financial year.
Cool.
And look at that going forward.
Yeah.
But out of that, that's the key thing I'm going to do.
Yeah. And I said to you, don't worry too much about zero and the balance sheet. But
yeah, no, I'm just going to do it as an extra page on my my spreadsheet. Most of the columns are already there.
Yeah, you've got the data. Yeah.
Yeah.
Yeah. Cool. Good, Brian.
What?
What was the main thing you got out of today, and what are you going to do as a result?
Actually, I was just trying to think of a way of doing it without having a spreadsheet for this, spreadsheet for that. Try and get it all in one. That's where I'll get in, where I got in the mess with my accounts before, was having a spreadsheet for this, spreadsheet for that. Yeah. And not all of it was going in one direction. So I'd have, what I mean is the bits I would forget to put into one spreadsheet and not into the other for it to actually marry up, which got better now, which
I'd have to say that if you're serious about the business and you do want to build a business, you've got to have an accounts package. You cannot run a business on spreadsheets. Well, you can. Damien's done a really good job for the past 6 years, but
it's also zero makes it just easier, doesn't it?
It's just easier. It's just there's no need to do it. I mean, I've built businesses on spreadsheets in days when there weren't, or accounts packages cost you a bloody fortune.
Yeah. And
they weren't particularly good. So I know, I've built some fabulous spreadsheet businesses. Okay, but I would not, no way would I do that now, because the systems now are so much better, so easy.
so much cheaper as well.
and so much cheaper. You know, you can pick them up for £10 a month. You know, it's like,
Why bother? Yeah.
why bother? Why spend all that time? My time is more valuable. So, you know,
My problem was when I opened it up, my accountant gave me a link, and the Zero told me my balance was minus £5,000, even when I plugged in all my bank account details, and my bank account is telling me something else. And then when nobody's there to tell you how to actually use it properly in an established business, it's not as easy as kind of
accountant, isn't it?
yeah, let's say, you know, you've been that's the problem. You've been let down by a bad service, and then you would naturally then, oh, I'll just stay as I am then.
I just fall back to my comfort blanket of my own.
Exactly. Yeah.
Mm.
So really, Brian, for you, it's look, you know, we can find you an accountant to do that, you know, but you know, it's these systems are not, you know, if you've got some. It depends on your level of computer skills. You know, if you can spend some time, there's some good videos on it. You're not starting where Damien was with stuff already. You know, you can just say I'll start from today, and then just put the invoices in and expenses in, and away you go. And there are some, you know, simpler systems. Yeah. Zero's not the most intuitive. QuickBooks is actually more intuitive. It's not as good, but in the early days, you know, it's not a bad one to start with. But you know, but I would definitely say don't if you're starting, don't start with spreadsheets, because you have to be a bloody spreadsheet genius like Damien to actually make them work.
Call myself a genius.
Yeah, in terms of the actual accounts, that's all on the spreadsheet, and that gets done on a daily basis. So that's all there.
Yeah.
The point I was getting to was like with the balance sheet, instead of having another spreadsheet for that, so having a way of incorporating it within what's already there.
Look, you won't do. I mean, I wouldn't even attempt to do a balance sheet without an accounts package.
Okay.
It'll take you two years of learning double entry bookkeeping to do that. You won't, because I did it, because when I was 17, 18 years old, you know, I joined an accountancy firm, and I was trained on that, and it took me 2 years to master it. And that's all I did all day was that, whereas you've got a job to do. So just don't even bother trying to do a balance sheet unless you do it through an accounts package.
Yeah, so that's where QuickBooks will come in, I guess. Yeah, right, okay. Yeah.
So if you're okay, you know, you don't want to make that change, then what I would say is a bit like with Damien, stay as you are, yeah. But then really the first step really would be to do the budget, to do your forecasting of, right, what's my income projections, what are my costs going to be. You must know your break even, so how much do I need to do in order to break even? Yeah. And then we can then monitor your actuals to that budget. Okay, on a monthly basis. So I said I was going to turn over this, and my costs were going to be that, and this is what's actually happened, and then I've got an indication of how well I'm doing. So, okay, Chris, what about you?
So I've got a question for you, Kevin. I had a meeting last Thursday with one of the people in my team that I'm handing over, given more responsibility to start doing KPIs.
Yeah.
So I've kind of got a vague idea of what I'm going to hand over the KPIs, but what would you suggest for me, and say between 3 and 5 KPIs for somebody else doing that within the business?
So what's their role?
So they do they're admin and after sales, but they're moving towards finance as well. So they're starting to manage the VAT. They do payments, VAT. So more the finance. I want to move them towards finance, so away from admin and more.
Okay. So what's a good what's a good result in the next 3 months by taking this person on? How can they influence?
So they're already in the business. It's just moving them onto a different level.
Yeah.
So, but also she would then pass on that information to the rest of the team, and the team can then see, you know, it's for me and for her and for the team.
Yeah.
So, and also just thinking about like having the biggest impact. One of the ones I was thinking is because she can directly influence the cost of sales, because she's involved in the booking and the ordering, oversees the, you know, the parts and repairs. But at the same time, you know, we're talking marginal gains on saving costs on producing. Essentially, it's production, isn't it? And we're talking, we could get marginal gains there really on the you know, cost per unit. So it's what's going to have the biggest impact overall for the business in, you know, between 3 and 5. It's kind of like KPIs for beginners, you know.
Well, I think you're right. It's always looking for start with where the biggest impact can be.
Yeah.
So whatever it is, where's the biggest impact? So for you, the biggest impact is turnover of cars.
Yeah. So more sales and profit per unit, isn't it?
A profit per unit.
Yeah. Okay.
So that's where I'd start.
So there's two key ones there, isn't there, to start with? Yeah. Okay.
So you're going to monitor those, and then as a team, because it's a team game, we're going to come up with 2 or 3 things that we can do each month to improve. How can we turn around cars quicker, and how can we increase our profit per unit?
Okay. Yeah. Got it.
Don't do too, you know, in a small team, don't do too many. 1 or 2 is fine.
Just 2 or 3. Yeah.
Once they've smashed that, then you can say, right, well, let's come up with another area.
Yeah. Got it. Okay. Yeah. Okay. And there is one positive to Jane breaking her leg, because this dictation service that you've got now, that you've got her on typing, she's amazing. She's so fast at that.
She's quick, isn't she?
Yeah. The only thing I would say is that sometimes she struggles to keep up with certain things.
Yeah.
So when you said that you were 17 or 18 years old at one point, she put down that you were 1,718 years old, which I thought, I mean, that is a bit harsh, isn't it?
Yeah, I think she's nodded off now. I think she's. Oh no, she's back. She's back.
What services are you using for that, Kevin?
It was part of Zoom.
It's really entertaining. I like watching it and seeing what it comes up with.
I'm not sure if it was Zoom or whether it was PowerPoint, but literally as I was opening it up, it said, "We've now got this subtitle thing. Would you like to use it?" And I thought, yes.
Makes you feel what it would be like to have poor lip reading skills.
Yeah. Well, I'm going to do one for the deaf as well, so I've got the person doing the hand things in the back. So.
Yours would have too many swear words in it, Kevin. You can't do
that. Cool, good. Well, hopefully that's safe. There's a lot to cover in a short period of time, but hopefully that's given you an idea of the key things to focus on. Obviously, we'll bring those into the group coaching and the 90-day plans as we go forwards. So I look forward to seeing some budgets and profit and loss and balance sheets, and otherwise have a good day and enjoy your weekend. So
thanks, Kevin.
Awesome.
See you later.
Kevin. Thanks, guys.
Thank you.
See ya.
Bye. Yeah.